Hello everyone, this is Alejandro and today we're going to be talking about how much is your startup really worth. So here's the deal. There are so many startups out there that have crazy valuations without really not much to showcase for. I mean, let's talk about, for example, Instagram. So Instagram went from like nothing to $1 billion in valuation in absolutely no time. So today, if you're wondering what your startup is worth, how can you achieve, an amazing valuation, this video is for you. And then also thinking or trying to determine what is the valuation of your company is a critical point. If you stay until the end of today's video, I'm going to give you a really nice tip that could help you in boosting your own valuation. So with that being said, let's get into it. So why startup valuation matters? So essentially your startup valuation is critical. It's going to be a critical thing that you're going to be using during your interactions with investors, where you're negotiating what could be that potential deal on your next round of financing. Knowing your valuation is going to make all the difference. Now, there's one thing that you got to keep in mind, that signaling is everything. And what this means is that when you get out there, when you're engaging with investors, you are now, they're asking you more in detail about your financial model, your numbers, what could be the potential value of the company. You got to keep a couple of things in mind. One is, obviously, you don't want to be throwing the valuation first, because in this, there's a game, right? So whoever talks first is going to lose. If you talk first on the valuation, they're going to negotiate you down. If they talk first, you're going to negotiate them up. So what you want to do is you want to find a medium where you're able to keep that number tied to the vest, but only disclosing in the event that you need to. Now, the other thing to keep in mind too is that 90% of startups fail. And one thing of the journey is that you need to know that signaling matters. And what I mean with this is that when you go out and you start throwing numbers around, the investor is going to feel whether you have been able to do your homework or not. And that's why having a concrete value in your business is going to make all the difference. So what determines a startup's value? So there are multiple factors that can come into place as part of the valuation of the business. It's not so much the financial model, or only the financial model with, let's say, the projections, the amount that you're thinking about raising. All of that is important, don't get me wrong, but there is other things that are going to come into play that are also going to be extremely important. And those are the following: traction, reputation, prototype, and industry trends. So let's go one by one. So traction, again, is the momentum, the progress that you're able to showcase for the business. The reputation is critical. I was, for example, speaking with a founder the other day that told me, hey, I was reaching out to investors. I got a 5% response rate, but then I went to Stanford. And by going to Stanford, I was able to increase my response rate from 5% all the way to 90%. And because I was like literally sending them emails from my Stanford email account. So that reputation, like those signalings that you're able to send from the company that you worked at before, from the university that you actually studied at, are also going to be super important. Industry trends are also essential. Why? Because, for example, the hype that is in your market is going to really push, things forward. For example, now artificial intelligence, AI, everything is AI. Investors are all over AI. So there's going to be hypes, in certain segments where it's going to be higher or lower, and that is going to be changing over the course of time. And then the other thing to keep in mind too is what you're able to showcase. What kind of tangible thing you can show to those investors. And typically that's going to be the prototype or some sort of minimum viable product where you're able to showcase to them how things are looking. Obviously, the more tangible that you can make it, the better it's going to be. But you got to be careful too, because you don't want to wait too much when it comes to showing that tangibleness of your business. Because if you wait too long, then obviously you may be too late for those investors that you're looking to target, and too early for the investors that are going to want to take a look at what you're doing on the next financing cycle. And typically financing cycles, they are between 18 to 24 months. Now, there are also negative factors which are going to be decreasing your valuation. And those are the following: poor industry, low margins, desperation. So for the poor industry, it's just like we discussed earlier. You want to be at the right time in history, and you don't want to be in a segment that is essentially slowing down. The market is decreasing. The compounding annual growth rate is really not at a rate that is appealing to investors, because in the end, the size of your market and how that market is growing over the course of time is also going to justify their potential returns and the risk that they're putting by investing in your business. business. The other thing to also keep in mind is the low margins. To put an example, in e-commerce and your gross margins are 40%, it's going to be very difficult again for them to justify that. So again, keep in mind, your margins and what is going to be your take home after all the operations, and all the effort that you're putting into this. And then the other thing too is the desperation, the signaling that when you go out there, you got to really keep in mind that it's not all about mastering your storytelling, which is your narrative, your pitch deck, the financial model, but then also the way that you're engaging with investors. Because keep in mind that when you're out there and when you're mastering the process itself of fundraising, there's going to be psychology, strategy, and methodology all coming into one. One thing to, again, master in this place is that you do not want to seem desperate. In many instances, I see founders that go at it, on the fundraising journey, and right away, they just are blindfolded. They don't know what to do. They start acting desperate, because they really need the investment. And that can really come and hit you back. Don't be desperate. Understand that fundraising is very systematic. You got to go from point A to point C and know exactly what needs to happen from one point to the next. Now, the other thing also as part of that desperation to avoid it, don't try to raise money when you are completely out of runway. You need to raise money when you have enough runway, enough oxygen, so that you can leverage that, so that you can raise around on your own terms. So with that being said, I want to touch on the different valuation methods for your business. The venture capital method, which is the method that calculates valuation based on expected future revenue. Investors estimate your startup's exit value and work backward to today's valuation. Then you got the Verkus method. The Verkus method assigns dollar values to different parts of a startup. If you check all the boxes, your startup could be valued at 2 to 3 million before making a dime. Then you got the scorecard valuation method. Investors compare your startup to others in your space and adjust based on strengths and weaknesses. If similar startups are valued at 5 million and yours is stronger, your valuation could be higher. Then the risk factor summation method. This method adjusts valuation based on 12 factors like management strength, market demand, and legal risks. Then you got the cost to duplicate method. This calculates how much it would cost to rebuild your startup from scratch. The downside, it doesn't consider future growth. Then the discounted cash flow, the DCF method. If you are generating revenue, this method predicts future cash flow and discounts it back to today's value. And then the valuation by stage method, where investors use this for a quick estimate based on milestones. If you have a working prototype, your valuation might be 2 million. If you have customers, it would be over 5 million. And lastly, the first Chicago method. This method gives 3 valuations: the best case, the worst case, and normal case. It helps investors see the full risk-reward picture. So what is the secret to boosting your valuation that I mentioned that I was going to give you? The secret is very easy. The secret is that you want to showcase a story of growth, you want to showcase traction, you want to showcase momentum, and you want to build that so that the investor is able to really connect the dots. Think about, for example, WhatsApp. They were acquired by 19 billion by Facebook. I mean, even one of the founders of WhatsApp, he even tried to apply for a job at Facebook and he got rejected. And obviously this was a costly hire now back to Facebook because it was 19 billion. But how they were able to do that without having any type of revenue? The reason why that was the case is because they were able to showcase that they had 450 million users. Look, I'm not asking you to have millions of users already registered, but you need to show a story of growth. You need to grab one metric or something that showcases to the investor the fact that you're growing over the course of time. Thank you so much for listening to today's video. Make sure that you share, that you subscribe. And also, if you want to have a session with me, a free consultation session, you can go to alejandrocremades.com/consulting. And there, I'll be very happy to chat with you and see what's possible for you and your business. Thank you so much.